In 2019, WeWork reached a $47 billion valuation. That massive number was a ticking bomb, built on the unstable promise of hyper-growth. The company's growth projections ignored the math of commercial real estate. They spent billions chasing global scale while losing money on nearly every desk they filled. This chart tracks the resulting collapse. By August 2023, the market cap plummeted to roughly $450 million. While the public spent years treating WeWork like a tech giant, traditional financial institutions finally evaluated it for what it was, an over-leveraged real estate firm. Investors ultimately rejected the company's corporate mythology, treating the collapse as a failure of the model itself, rather than a standard market correction. In November 2023, the mounting pressure reached a breaking point, and the company formally filed for Chapter 11 bankruptcy. This scale shows the fatal imbalance. WeWork entered the courts carrying $18.7 billion in debt against only $15.1 billion in assets. This massive deficit structurally suffocated the business. Every dollar of revenue was swallowed by debt, leaving no room to operate. At the time, the media and the broader real estate industry wrote the company off as a permanent casualty. Reanimating a failing company requires surgically removing the structural disease from the balance sheet. By 2026, the company defied its death sentence. It orchestrated a complete turnaround through the bankruptcy courts to emerge utterly debt-free. In 2025, WeWork reached profitability, generating nearly $2.3 billion in revenue. Unlike the peak valuation era, this $2.3 billion represents actual cash flow rather than venture capital subsidies. Achieving this resurrection required abandoning empire-building ambitions in favor of ruthless financial discipline. CEO John Santora took the lead, with a mandate to replace visionary rhetoric with operational austerity. He stabilized the company at exactly 600 locations, a massive reduction from the bloated footprint of the past. Despite shrinking significantly, the company still maintains a global footprint across 37 different countries. In a strategic paradox, radically shrinking the size of the business was the only way to actually secure its survival. Fixing the balance sheet meant addressing a specific operational flaw, the company's history of acting as a master tenant through aggressive property leasing. Under that model, WeWork committed to decades of fixed rent payments to landlords, regardless of whether they filled their own desks with tenants. When the market turned down, WeWork absorbed 100% of the real estate risk, trapped by immovable lease agreements. This created a massive physical liability, empty offices that still burned through millions of dollars a day in owed rent. Their strategy relied on taking a commercial landlord's most dangerous gamble without owning the underlying assets. To survive, they executed an asset-light pivot. They abandoned traditional leases, moving that massive real estate risk entirely off balance sheet. The new blueprint utilizes management agreements and revenue-sharing deals instead of standard rentals. This flowchart tracks the new flow of capital. WeWork operates the space for a guaranteed fee, while the landlord takes on the burden of occupancy risk. The company now operates as a bulletproof white-label service provider, which is a significant departure from its former high-risk tech profile. Transferring the fundamental burden of risk back to landlords allowed them to swap a volatile valuation for $2.3 billion in steady annual revenue.